Hello, hello, hello. Good afternoon. Jeremiah Conjure here from Annuity Association, and we're back to bring another super duper unbiased annuity review. Today we're going to be discussing the Retirement Plus Multiplier fixed indexed annuity that's offered by not one, but two insurance companies. They happen to be sister companies under a larger conglomerate, but both offer this unique annuity with the same exact features, benefits, rates, and more. So essentially in this review, we're going to be covering a product review for two different companies that happen to be sister companies. Those are Sentinel Security Life and Atlantic Coast Life. The product, again, is the Retirement Plus Multiplier. So in today's review, we're going to be discussing the features, benefits, rates, and more. If this is the first time that you're watching one of our product reviews, you're really in for a show that's going to basically break down and take a deep dive into the specific product features and benefits. We're going to be going through the product brochure, making sure that we understand everything that's available to us in that, and then also taking a deeper dive into our software that's going to take a look at the specific index crediting strategies offered in this unique product. And we're going to take that through a back testing exercise to see how this product would have potentially performed if we owned it during that time frame. So we're going to be looking back over the last 10, 15, and 20 years to see how those crediting strategies would have held up during the economy at those time frames. So this is a great opportunity for you if you're looking for more details on this specific product and you're looking to compare this product to maybe some others on the market. This is going to be a very good opportunity for you to understand all of the features, benefits, rates, and more of the Retirement Plus Multiplier offered by Sentinel Security Life and Atlantic Coast Life. Just want to start off, like I do every review, with some gratitude. Thank you for watching. Thank you for tuning in to our channel. We're hoping that you're getting some value out of this review and other reviews that we have available to you on the annuity marketplace. Our premise, our mission here at Annuity Association is to help bring more transparency to the annuity buying experience for you, the end consumer. We're not a company that is here to sell you anything. We're actually here to help you understand through education on all of the many various annuity products available to you on the market to ultimately help you make an educated decision on which one is right for you. Now, we are an independent firm. We work with clients in all 50 states. So if you're interested in understanding annuities in a more deeper, at deeper length, and you're looking to work with an independent advisor that can give you an apples to apples comparison on all of the annuity products available on the marketplace today. We work with clients in all 50 states. You can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and I will personally reach out to you in a timely fashion to see how I can help point you in the right direction. So without further ado, we're going to go ahead and dive into the disclaimer here and get that stuff out of the way, and then we will dive into the product brochure, and then later on into our software to take a look at the index crediting strategies. And if we have time, we'll also review a example illustration on this product to show you how it would look on a ledger. So if you haven't done so already, you can enlarge your viewing window by clicking in the bottom right-hand corner of your screen. There should be a little box symbol. When you click that, it will enlarge it. So again, we're looking at the Sentinel Security Life and Atlantic Coast Life Retirement Plus Multiplier fixed indexed annuity. This is an unbiased independent review brought to you by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. Sentinel Security Life and Atlantic Coast Life have not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners. and not that of annuityassociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. All right, so first things first, we're going to go ahead and dive into the product brochure. Now, I do have both brochures pulled up here, but they're exactly the same. Some of the images are different, but the layout of the brochure is exactly the same from both companies. So today I'm just going to be covering the Sentinel Security Life brochure on the Retirement Plus Multiplier. But again, they're exactly the same brochure. Just want to make sure that we understand that. But I am just going to cover the Sentinel Security Life version of the brochure. So again, we're talking about the Retirement Plus Multiplier Fixed Indexed Annuity, brought to you by Sentinel Security Life and Atlantic Coast Life. So you have paved the way. Baby boomers redefined life in America in so many ways, blazing the trail in everything from technology and consumer goods to cultural elements like music and social norms. This is a generation of innovators with a true zest for making the most of life. Because of their contributions, our world is more exciting, full of choices, and more accessible than ever before. And now it is time to enjoy the ride. As the great wave of baby boomers enters a new phase of life, the meaning of retirement has also undergone a radical transformation. Leaving the workday world is not slowing people down, quite the opposite. Retirees are embarking on new adventures and are serving as a catalyst for changes in healthcare, senior living, and a host of services geared toward older adults. And the Retirement Plus Multiplier Annuity was created for a new generation of retirees. So planning your retirement. As you think about all the ways you want to enjoy retirement, it's important to create a financial strategy that would allow you to make the most of your money and other sources of income. So you can enjoy the lifestyle you envision, your strategy must also address potential events that could negatively affect your finances. Below are key considerations for your financial future. So the first is the principal. Protect your principal from market losses. Markets go up and markets go down, but volatility during your retirement years can greatly impact your financial strategy more than ever before. Negative performance is magnified when you're also withdrawing funds for income. Your strategy should include financial products that minimize or prevent losses to your retirement money due to downswings in the market. Next is rising cost. While the U.S. has enjoyed relatively low inflation rates in the last decade, advances in technology and our standard of living have increased the cost of common expenditures, including the price of cars, food, and potentially most important, healthcare. Your budget should account for both necessary and optional expenses and provide room for rising costs over time. And then next is longevity. As we live longer and longer, our time in retirement often extends as well. That's great news, but you'll need to plan for up to 30 years without an employer's paycheck. Make certain your strategy includes ways to maximize your money to go the distance. Low interest rate environment. During retirement, it's important for your money to continue to work for you. Low interest rates have made conservative growth options less attractive for retirees. Your strategy should strike an appropriate balance of protection for your money and opportunity for it to grow. So the Retirement Plus Multiplier Annuity is a fixed indexed annuity designed to help you prepare for your financial future. It's going to give you the ability to participate in potential market index growth, protect accumulation value from market loss, provide retirement income for your lifetime, and you can choose from a variety of options to best fit your financial needs. So first things first, and that's capturing the market's upside. At this stage, preserving your money is just as important as getting a meaningful return. The Retirement Plus Multiplier Annuity provides greater earnings potential than fixed rate options. Your annuity's growth is tax deferred, which means you do not pay taxes on the interest earned until you make a withdrawal. You may elect to allocate your funds among several index crediting strategies in a fixed rate option. Index crediting strategies will grow along with the market, and credits are applied to your contract's accumulation value subject to either a percentage cap or a participation rate. Even when market performance drops, your money is protected. The guaranteed interest rate is 0%, so if the market stays flat or goes down, your credited gains are protected from loss. And you can also boost your annuity's potential. You may select one of the two optional riders to enhance your annuity and customize the benefits to meet your goals. The first rider is the growth benefit rider. This is also referred as an accumulation buy-up rider. If the accumulation is your main priority, this rider increases the growth potential of your annuity's index accounts. When you purchase this rider, the participation and cap rates are increased to your annuity benefits from more of the market's positive performance. You have the potential for better growth with higher index account caps and participation rates. You still get that guaranteed 0% floor, which protects your accumulation value from market loss, and greater of the account value or 110% of initial premium less withdrawals guaranteed after the first 10 years. So even if the index strategies don't perform, they're still offering you a guaranteed growth of at least the greater of the account value or 110% of initial premium less withdrawals. And that's guaranteed after the first 10 years. Okay. On the right-hand side, we have the second rider option, which is called the income multiplier. And this is the guaranteed lifetime withdrawal benefit rider. Maximize the potential income from your annuity with this rider. This optional benefit will enhance your potential income, which you'll never outlive, even after your accumulation value has been withdrawn. You can generate a stream of income for life, an option to elect income for you and your spouse, and income enhancing bonus of up to 100% of your initial investment. So just below each of these two rider options are going to put up a graph here. On the left-hand side, which is the growth benefit rider, they're showing us a chart with the contract years on the bottom and the dollar account value on the left-hand side. The dark blue line is the S&P 500 value. The I guess that'd be a light brown shade is the S&P 500 one-year participation value. And then the gray is the S&P 500 one-year participation with buy-up rider. So they're giving us an example that, first off, the S&P 500, it's showing you the performance for just the general S&P 500. That light brown shade is just showing us the regular S&P 500 option with the one-year participation. And then if you elect to add the growth rider, that would be reflected on that gray line, showing you above and beyond the S&P 500 value, that gray line actually outperforming both of the other two. So this scenario is based on a $100,000 initial premium and the selection of the growth benefit accumulation buy-up rider with 100% of the premium allocated to the S&P 500 one-year participation rate index strategy. This example reflects the S&P 500 index values from March 1st of 2007 to March 1st of 2017, a 35% participation rate on the S&P 500 one-year participation rate index strategy, and a 55% participation rate on the S&P 500 one-year point-to-point participation rate index strategy with the buy-up rider. This example is hypothetical only and is meant for illustration purposes. It is not a prediction of future results. This product was not available during the specified time frame. And on the right-hand side for the income multiplier, the graph here is showing us the initial premium, which is in the dark blue color. In the light brown is the S&P 500 one-year participation interest, and then the income multiplier bonus is the light gray. And you'll see that every single year that we defer the income stream, the light gray adds a significant increase or multiplier bonus on the lifetime income. And this scenario is based on a $100,000 initial purchase premium, the selection of the income multiplier guaranteed lifetime withdrawal benefit rider, 100% of the premium allocated to the S&P 500 one-year participation rate index strategy, and an issue age of 70. This example reflects S&P 500 index values from March 1st of 2007 to March 1st of 2017, and a 35% participation rate on the S&P 500 one-year participation rate index strategy. This example is hypothetical only and is meant for illustration purposes. It is not a prediction of future results. This product was not available during the specified time frame. So let's talk about the index accounts that are available. And again, if you're interested in figuring out how these index strategies potentially could perform, we're going to be taking a deeper dive into those momentarily in our software to take those index strategies through a back testing exercise to see how they would have performed over the last 10, 15, and 20-year periods. So there are several index account options that are available, which are linked to different market indices. You have control over how your money is allocated among the different index accounts and the fixed account. You can reallocate at the end of each crediting period. So the first is the Goldman Sachs Aging of America Dynamic Balance Index, created by Goldman Sachs and Company. The index dynamically allocates to equities as represented by the Active Aging of America Total Return Index and U.S. Fixed Income as represented by a 10-year U.S. Treasury Rolling Futures Index. The Active Aging of America Total Return Index seeks to provide targeted exposure to companies in the healthcare and real estate sectors that may benefit from the long-term demographic shift towards an older population in the United States. Exposure to 10-year U.S. Treasury Rolling Futures Index, a known fixed income benchmark, is based on a daily observed momentum signal. The Goldman Sachs Index includes a volatility control feature and is calculated on an excess return basis. So in that strategy, they offer a 1-year crediting period with participation rate, 2-year crediting period with participation rate, and 3-year crediting period with participation rate. We'll be covering those momentarily to see which of those three could potentially provide us the most growth opportunity moving forward based on those par rates and things that are associated. And on the right-hand side, they give us a cool stat here. 10,000 Americans turn 65 every day. And by 2030, 20% of the U.S. population will be 65 or older. 5.8% per year projected growth in healthcare spending through 2024, 1.3% faster than the GDP. They also offer the S&P 500 index, which is comprised of 500 major companies representing leading industries of the U.S. economy. They offer the S&P 500 index with a 1-year crediting period with participation rate, a 1-year crediting period with cap, and a 2-year crediting period with participation rate. Again, we'll be taking a look at these indexes momentarily to see how they would have performed over the last 10, 15, and 20 years to help us get an idea of which index strategy may be right for us. And then calculating the index interest. At the end of each crediting period, index accounts can earn interest based on the index's positive performance during that crediting period. Interest is subject to a participation rate or cap. So participation rate is the percentage of the index growth used to determine the interest. And a cap rate, of course, is a maximum interest rate credited to the index account. So the easiest way to understand a participation rate is to basically break it down in the sense of the index's positive performance, how much do we as the investor or consumer participate in of that growth. So for example, if the index's growth was 10% over the crediting period, well, if we have a 50% participation rate, that means we would be able to earn half or 50% of that 10% growth. In that case, it'd be a net of 5% credit given to our contract value. And of course, there is a fixed account in these annuities as well. The fixed account provides a predictable, reliable growth option with no market risk. Funds allocated to the fixed account earn daily interest at a specified rate, which is guaranteed for 1 year. We'll be taking a look at the fixed rate as well. So in most fixed indexed annuities, there is the ability to access your money, and they do that through penalty-free withdrawals. The Retirement Plus Multiplier annuity offers several options to access your money without being subject to surrender charges or market value adjustments, including during the first contract year, you can withdraw the interest that will be earned on funds allocated to the fixed account or a required minimum distribution. Required minimum distributions are available penalty-free in all years. After the first contract year, you can withdraw up to 5% of your accumulation value or required minimum distribution, whichever is greater. If you are diagnosed with a terminal illness or confined to a nursing home after the first contract year, you can make a full surrender or partial withdrawal under certain conditions. After the 5th contract year, you can apply the accumulation value of the contract to purchase a settlement option to provide income. And you can take up to 2 withdrawals in a contract year as long as your accumulation value does not go below $2,500. Withdrawals must be at least $250. So if you're looking to access your monies, maybe you need additional liquidity for a rainy day event, you can access up to 5% of your accumulation value after the 1st contract year with no penalties incurred whatsoever. Now, there is a surrender charge schedule in a fixed indexed annuity because they are what we call time deposit vehicles, and they offer the guarantee of principal protection. In order for the insurance companies to make these products work, they have to understand that you're going to keep your money in these accounts for a certain amount of time. Now, the Retirement Plus Multiplier does come in 3 different contract year versions. They offer a 5-year version, a 7-year version, and a 10-year version. And those surrender charge schedules for each are located right here. You'll see on the 5-year version, the 10% surrender penalty applies, and then each year thereafter, it decreases by 1% per year, ending with 6% in contract year 5. Once you've fulfilled all 5 contract years, the surrender schedule drops to 0%, meaning you can access all of your monies with no penalties whatsoever. The 7-year schedule starts at 10%, goes down 1% each year, ending with on year 7, 4%. And then the same thing with 10 years, starting at 10%, going down 1% each year, ending year 10 with 1%. And with all annuities, there are what we call settlement options. All annuities have the ability to convert to a lifetime income stream, even if you don't elect to add the lifetime income rider. You still do have the option to do what's called annuitization of your contract value. So you may choose after the 5th contract year or at death when you start to receive annuity payments and the duration in which they are paid. The accumulation value and the settlement option you select will determine the payment option, the payment amount. So there is a lifetime income only option, which is equal monthly payments for the annuitant's remaining lifetime. Payments will end with the payment due just before the annuitant's death. No death benefit is payable with this option. They also offer period certain only, which is equal monthly payments that are guaranteed for a specific period, not less than 10 years and not more than 20 years. And after the 5th contract year, you may request a period certain of not less than 5 years and not more than 20 years. So again, these are annuitization options. They're not required. They're not mandatory. It's completely optional. But really, when this might be of interest is after, a handful of years, at least after 5 years, maybe you get to a period of time in your life where you see that you have a decent amount that's accumulated in the account value. And now you're interested in converting it to a lifetime income stream or what's called a period certain income stream that covers a certain period of time. And if that's the case, you'll be giving a schedule that will indicate how much income converting your contract value at that time would equate to. Now, keep in mind, when you do annuitize the contract, you do give up access to that account value in exchange for the payment settlement option. So it's a rare feature that's used these days. Most times, if someone's looking at an annuity for income, they usually will purchase the lifetime income rider. And the reason for that is because when you purchase the lifetime income rider, you're still able to control the account value. You do not give up control over that account value in exchange for the lifetime income payment. So that's the attractiveness of the lifetime income rider. They also offer lifetime income with guaranteed period certain, which is equal monthly payments for the greater of the annuitant's remaining lifetime or specified period of time. If the annuitant dies after payments have been made for the specified period, payments end with the payments due just before the annuitant's death. And then, of course, the death benefit. So one of the biggest misconceptions in an annuity is that if you pass away, the insurance company keeps your money. That's completely false. There's only one type of annuity structured in one type of way that would ever be the scenario. In 99% of annuities out there, there is a death benefit that's offered. and that's no different than in this product as well. A death benefit is payable to the annuity's beneficiary if the owner or the annuitant, if the owner is not a natural person, dies before the annuity payments begin. The amount payable is equal to the accumulation value or the minimum guaranteed surrender value determined as of the date of death, whichever is greater. If any of the accumulation value is allocated to an indexed account with a 3-year crediting period and the owner passes away during the crediting period, the accumulation value will receive interest credited to the date of the death. Okay, so they provide a few disclosures here, but many of them are what we covered. I will cover a few of them here. The annuity guarantees rely on the financial strength and claims paying ability of Sentinel Security Life and Atlantic Coast Life Insurance Company. And we've covered all of these with the exception of the nursing home waiver. So the nursing home waiver is offered in this product. It's a great feature for peace of mind that in the event, you have additional needs for money to pay for the cost of nursing home care. The nursing home waiver will give you access to those monies. And in order to qualify for the nursing home waiver, you must be confined to a nursing home for a period of at least 90 consecutive days. And there is a waiting period of 1 year. If the owner is confined to a nursing home during the waiting period, this benefit would not be available in certain states. And then they also offer the same thing for terminal illness, which is the terminal illness is defined as a medical condition which a physician certifies that the policy owner's expected lifespan is 12 months or less. Proof of the terminal illness is required by a certified licensed physician that is not the owner, annuitant, or family member to the owner or annuitant. The owner cannot be terminally ill during the waiting period, and there is a waiting period of 1 year. Okay, so we covered all of that. And now, one other thing we're going to cover here that we did not cover is on the for the rider fees. So there are the 2 optional riders that you can add to this specific product. The first one being the growth rider, and the second one being the income multiplier bonus. And if you elect the guaranteed lifetime withdrawal benefit rider, there is an annual fee on each contract anniversary of 95 basis points, so just under 1%, multiplied by the accumulation value and reduced proportionally from each account. If you elect the accumulation buy-up rider, there is an annual fee on each contract anniversary of 1.25%, multiplied by each index account and subtracted by from the corresponding index account. Okay, so that wraps up the brochure. So let's go ahead and dive into our back testing exercise, where we're going to take a deeper dive into the specific index crediting strategies on the Retirement Plus Multiplier fixed indexed annuity offered by Atlantic Coast Life and Sentinel Security Life. So what our software here is designed to do is take a look at the specific index crediting strategies that are offered in these annuities and then back test them over the last 10, 15, and 20 years to see how they would have potentially performed if we owned those contracts during that time frame. Now, I must make the disclaimer that prior performance is not always an indicator of future performance. And since none of us have a crystal ball to know what these products can do moving forward, I do still feel that this exercise is important to really give us an understanding of what it could potentially do moving forward if markets were to perform similarly during the last 10, 15, and 20 years. So here we have the Retirement Plus Multiplier using the 3-year Goldman Sachs MOTIF point-to-point with a participation rate. And this is using that accumulation buy-up rider. So the rider, you'll see the fee here is 1.25% annually. And then the top strategy using the growth rider and back testing it is the 3-year Goldman Sachs. And when we look back over the last 10 years, this particular index strategy would have performed on average of 9.34% annualized rate of return. And if you look just below that, we have a green and red number. The green number indicating the best 10-year performance over the last 20 years and the worst 10-year performance over the last 20 years. So the green number obviously being from December 30th of 2010 to December 30th of 2020. The best 10-year period was 9.34% over that time frame. And then the worst 10-year performance, still a positive number here, just red indicating the worst 10-year performance, was from December 30th of 2007 to December 30th. Index strategies that are offered. Don't make the decision on the best case scenario, make the decision on the worst case scenario. So that 7.54% is a good, potentially good number there to use as the potentially worst case scenario. That particular time frame is taking us through the global financial crisis of 2007 and 2008, and assuming those losses that were occurred during those years. And if you're not familiar with that time frame, it took the markets about 5 years, maybe 5.5 years to break even during that time frame. And so with all that being considered, during that time frame, if we own this particular product then with all of the same parameters of the contract that's offered today, this product would have performed on average 7.54% annualized rate of return. So very solid numbers there. Again, all of these numbers also accounting for a 0% principal protection, meaning you'll 100% principal protection with a 0% floor, meaning even in down years, your money will never receive anything less than a 0% credit. Okay, so we've got the 3-year Goldman Sachs coming in number 1 with those accumulation buy-up riders. And then we also have coming in number 2, after the Goldman Sachs, they also offer the 2-year version of the Goldman Sachs. That would come in number 2 with 160% participation rate on that 2-year strategy. So what that means is your 2-year period is going to be your look back period. So the date that your policy is issued, that will be your anniversary date and the starting point of your index strategy. So in your policy, you'll receive the starting value of the Goldman Sachs, in this case, Goldman Sachs Motif index. It'll tell you the starting value of that index on the date your policy is issued. After your first 2 years, upon the anniversary date, you'll receive communication that indicates the ending value or the ending point of that same index. So if the ending value is higher than the starting point or the starting value, then you would be credited interest based on multiplying the 160% participation towards the growth of that index during that time frame. So again, if the index performed at 10% during that 2-year period, point to point, then you would receive a 16% credit since your participation rate is 160%. So 160% multiplied by the 10% growth would equate to a 16% credit to your account value. So we'll see the 2-year Goldman Sachs credited 8.68% over the last 10 years, average annualized rate of return, highest 10 years at 8.87% and lowest 10 at 7.29. And coming in number 3 is the 1-year point-to-point using the same Goldman Sachs Motif point-to-point with participation rate. This again is with that accumulation buy-up rider of 1.25%. And that 1-year point-to-point would have 125% participation. And we'll see the average annualized rate of return during the last 10 years if we own this contract during that time at 6.93%. The highest 10-year period was 7.18%, excuse me. And the lowest 10-year was 5.94. Now in this product, they do offer the S&P 500. So let's go ahead and scroll down and see where those come in. So the highest S&P 500 with participation rate is going to be the 2-year S&P 500 with participation rate. Again, using the accumulation buy-up rider of 1.25% annualized fee. And the participation rate is 56% with that rider. The last 10-year performance using our hypothetical backtesting exercise is 6.75% average annualized rate of return. The best 10-year performance is that 6.75, and the lowest 10 from December 30th of 2001 to December 30th of 2011 is 2.32%. The average rate of return over the last 15 years using this strategy would have been 4.94%, and the last 20 years, 5.84%. Okay, so that's the 2-year S&P 500 point-to-point with participation rate using the accumulation buy-up rider. And if we come down, we'll find the 1-year S&P 500 with participation rate as well. Again, with that buy-up rider of 1.25%, and the participation rate is 40% on the 1 year. And we'll see the average annualized rate of return over the last 10 years at 5.06%. That also ends up being the highest 10-year performance over the last 20 years. And then the lowest 10-year performance over the last 20 years from December 30th of 2001 to December 30th of 2011, we're still at 3.61%. Now, that's a great time frame to really take a deeper dive into. That's coming through the dot-com bubble of 2000 to 2002 and coming out of that 2003. And then we also have the global financial crisis of 2007 and 2008. So during this time frame from 2001 to 2011, that's including 2 black swan events in our economy that were some of the worst times in our economic history. And still, because of the contractual guarantee of principal protection, 0% floor, we come out with a 3.61% average annualized rate of return using that particular strategy. So very good thing to note there. Average rate of return over the last 15-year period was 4.78% and 4.33% for the last 20 years. So that wraps up our back testing exercise of the particular index crediting strategies found in the Retirement Plus Multiplier fixed indexed annuity offered by Atlantic Coast Life and Sentinel Security Life. And now we're going to take a look at an example illustration. Take a look at our guaranteed income calculator to see how this product can perform from a guaranteed income perspective using some hypothetical inputs here. So I'm going to go ahead and share my screen. And take a look here. We're going to look at a male age 60 in the state of Florida. Again, we work with clients in all 50 states. We're just going to use Florida for this example. If you are interested in working with me directly and you'd like to figure out if this annuity is right for you, you can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and I will reach out to you in a timely fashion to see when we can get together to help point you in the right direction. During our meeting, we'll utilize Zoom as a secure video platform to connect face-to-face, and we'll dive into what your needs are, goals and objectives, and then assess the annuity marketplace and figure out which one may be right for your particular situation. And I would be honored to have that opportunity to work with you and extremely grateful for that opportunity. Okay, so let me go ahead and get this product sorted out here. Okay, so we're looking at a male age 60 in the state of Florida. We're putting $100,000 in. And what this is going to do is show us the available income riders from Sentinel Security Life. Let's see if we can see Atlantic Coast as well. Okay, yep, we can see both there. But for this example, let's just look at Sentinel Security. Our software calculator here is dynamic, so we can defer it using this deferral bar, depending on when you're looking to turn on income. In this example, we're going to assume that the person would like to turn income on at age 67 when they plan to retire, which would be contract year 8. And then we'll see here the Retirement Plus Multiplier 10 using the income multiplier guaranteed lifetime withdrawal benefit rider, the income on that at that time frame based on age 67 would be $7,840 a year on that initial $100,000 premium investment. Now, let's break down the rider and how it grows to equate to that number. This particular rider is going to take a roll-up rate approach using the accumulation value plus a bonus up to 100%. So every single year that the index is growing and performing well, the actual credit that will be applied to the income benefit base is going to be an equivalent of that index credit from the index strategy. So it's basically how it's working to get to this number. Again, that's a 95 basis point rider fee for that particular rider. And we're seeing here this number to the right of the green number, 160,000. That is the $100,000 growing the income benefit to $160,000 by contract year 8. And then we'll see the actual payout rate, or what's also referred to as a distribution rate, of 4.9%, which is based on the age of the person turning on income. So every year that you defer it, so if I was to go up one more year, that percentage would increase by 10 basis points, in this case going up to 5%. And we see that the income benefit also has grown to $165,000. Those numbers multiplied together equals $8,250. So that is the income multiplier rider. So it's an example of how that works. Now let's take a deeper dive into looking at an illustration to show us, what this thing is really doing here to get to that number. So first things first, one of the benefits of working with us here at Annuity Association is our software has the ability to analyze all of those index crediting strategies to help us maximize the accumulation value, which in this particular product also directly correlates to the income benefit. So here we're going to go ahead and just assume that we're going to select the top index strategy. So we're going to allocate 100% of the funds to the 3-year Goldman Sachs Motif index with the point-to-point strategy. And then we're going to go ahead and look at age 67 at the time the income is going to be turned on. And so in this particular product, the nice thing about this product, and I don't think it's been expressed enough yet in this review, is that it does give upside potential on the income benefit based on how the accumulation value grows. So in this product, we'll see that it has a guaranteed minimum income no matter what the index strategy does during that 7-year deferral. The guaranteed minimum is going to be $7,840 a year. That's assuming the growth that's guaranteed on the income base grows to $160,000, and the lifetime withdrawal rate's 4.9% based on the age of that person of 67 at the time the income is turned on. Now, when we come on down, we're going to also see what this potentially could do from an increasing income perspective when assuming the account value and the accumulation value growing according to how the last 10-year performance would have unfolded in this annuity if we owned it during that time. So basically what we're doing is taking that 10-year back-tested performance and applying it to this illustration to then tell us, if the annuity performed like the index strategy potentially would have performed over the last 10 years, how would our income look based on this income multiplier rider that's available in this product? So the income multiplier rider gives us the ability to utilize the accumulation value and apply 100% of the index's performance and the crediting strategy's performance as a bonus over to the income benefit base. So here, year one, you see the $100,000 going in, and that there is a bonus that's applied after the first year to grow this income up to 110%, okay? Or excuse me, 110,000. So every single year that there's an index credit we're seeing that credit directly apply over to the income base. So for example, based on the last 10 years, after the first 3-year point-to-point strategy using the Goldman Sachs Motif 100% point-to-point participation rate, we'll see that 34.27% interest credit would have been applied to the account value and then directly over to the income benefit base. So because of this number applying over here, we're seeing a growth of that income base up to $169,620. Now, fast forward to contract year 6, we see another interest credit that's coming in of 12.81% after the second 3-year point-to-point crediting strategy, growing the account value to $143,000 and the income base to $221,000. So, with that being said, once the person elects to turn on income in this example, which is contract year 8, because of that benefit base growing, that income benefit base growing to that $226,692 figure, multiplied by the 4.9% lifetime withdrawal rate, that equates to a new income amount of $11,108. So the unique feature in this annuity, the Retirement Plus Multiplier, is that you get to take advantage of not only a high guaranteed income amount, but also you have upside potential based on how the index performs to have an increased income amount that's guaranteed for life based on that index's performance. Now you're getting a bonus credited to the income benefit base of that index credit. It directly correlates over to the income base. So it's a huge benefit. Not many annuities on the market today offer this type of feature. So I like the idea that, worst case scenario, we still have a really strong guaranteed income, but that it gives us upside potential based on the index's performance, that should it perform very well, we're going to exceed that guaranteed minimum and improve our overall income situation that's then locked in for life moving forward. And so you'll see that the $11,000 is coming out in income stream based on the $100,000 initial premium investment. And the other nice thing about this annuity is that it has strong accumulation opportunities. So that gives you the ability to sustain and maintain your account value for quite a while. So you'll see normally when an income stream turns on, it will start to reduce your account value. But because of the index crediting that's still applying here in this example, you'll see that you maintain your account value for quite a while, and it eventually does end up going to 0 at year 28 of this contract using this hypothetical example with the back-tested performance of the last 10 years. So hope this has added some value. Hope this all makes sense. If you have any questions, you can post them here right on our YouTube channel or Facebook page, and I'll be more than happy to answer those for you. If you'd like, again, to compare this annuity to maybe one that you already own, and maybe you're thinking about buying this one and you'd like to compare the features and benefits and pros and cons and really do an apples to apples comparison, we work with clients in all 50 states. I'd love the opportunity to work with you. If you're interested in doing so, you can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and I will reach out to you in a timely fashion to see how I can help point you in the right direction. I'd be honored for that opportunity. And again, just want to say thank you for tuning in. If you've gotten some value out of this review, give us a thumbs up or a like, and maybe share this video with some of your friends and family that could also benefit. It really helps our channel get ranked higher to help people find the information they're looking for to help them make an educated decision on which annuity is right for them. So thanks again so much. Hope everybody has a great day. This is Jeremiah Conger from Annuity Association signing off. Take care of one another. Thanks so much.